Rick, so I'm excited about our podcast here, man. Obviously, I think there's a lot of good information that we can do and give to the public. What we've prepared for everybody is a few slides that we're going to discuss various different tax-related subject matters per se. And in doing that, Rick, you want to go ahead and kind of kick it off in regard to the employee retention credits that are out there?
Yeah, I'd love to. Yeah. So this is kind of one of Jake and I's big, I would say, trap that a lot of people have been falling into here lately. We get calls all the time from our clients and from people that aren't our clients going, hey, I get these calls from these third parties saying I'm going to get $40,000, $50,000, $100,000 in ERC credits.
Yep.
And, is this legit and can I do this? And so,
and it's frustrating for you and I, you know, because the reality is we know the rules, we know the regulations that's associated with it, but these are a lot of frivolous claims and taxpayers don't know, but it sounds good to them.
Yeah. Well, I mean, who doesn't want to hear that I'm fixing to get a big check from the government, right?
Absolutely.
Especially from the IRS. And you go out and you Google, and it's really unclear who qualifies, right? You see one website that says, if you have employees, you qualify.
Yep.
And then another website says, well, no, it has to be X, Y, and Z. So, it can be very frustrating for the clients, the taxpayers to know, do I actually qualify for this credit, right? And these third parties, they don't make it easy because they're out there calling everybody 50 times a day. I can tell you my cell phone blows up a couple times every day still here, let me get you an ERC credit.
Absolutely. And I can't tell you how many times, I'll advise a client on the ERC credit and then they'll come back and say, well, I heard this or I heard that, right? And they're kind of contradicting you and you're like, no, that doesn't work. But they have someone, kind of preaching in their ear, telling them otherwise.
Yeah.
And so the IRS has kind of clapped onto this.
Yep.
And recently, there's basically these 4 different actions now the IRS has taken to kind of stop this, to stopping the new ERC credit claims per se.
Yeah. So back in September, the IRS put an announcement out and saying we're freezing the ERC program. Okay, not that we're not going to take more applications, not that we're going to process claims. We're just putting a halt because they were getting so many of these, I'll call them frivolous claims.
Absolutely.
Of stuff. And they were investigating and finding out that many of these claims that are being put into the IRS right now were unsubstantiated. You either didn't have the employees or you didn't follow the process that the IRS lays out for being able to claim these tax credits. So one of the things that we've worked through with our clients is we talk about what are the actual processes that you have to go through, right? And so one of them is looking at that COVID period, the 2020, the 2021 period, and looking at it, right? So just highlighting some things for people. The IRS right now, they say they've got 600,000 claims that they're processing, okay? And normally this process is taking 90 days, 120 days. They're now saying minimum 180 days or longer.
And I'm going to tell you this, Rick. If the IRS says it's 180 days, you might want to double that.
Yeah. Yeah.
And hey, it's no harp on the IRS. They're bogged down with so much to do right now. But the reality is a lot of these deadlines that they're placing, because originally it started with the 90-day processing, that's been bumped to 180. And, we've seen situations just basically even on amended returns, right? Where it's supposed to be returned to them in 6 weeks or 90 days. Heck, I represented someone the other day that he still hasn't received a refund from a last year's amend back in November.
Yeah. Yeah. And that's the thing is the IRS is so bogged down where they're still recovering from COVID and being shut down during the COVID. And yes, they've hired new employees. Things are getting better. I will say that the IRS is getting better. They're actually answering the phones now. That was for a long time. You couldn't even get anyone on the phone.
Do you remember how many times we used to tell clients, yes, I've called, 10, 15 times in a day, and either the call drops, they try to transfer you, you're on hold for 2 or 3 hours, and the client's basically thinking to themselves, yeah, right, I bet you didn't call. But that's how bogged down they were.
Or even my favorite was, due to the high frequency of calls, no one is available to answer the call right now. Please call back at another time and click, right?
Yeah.
And so, one of the things that taxpayers need to understand, honestly, is the IRS they're doing better, but they're not there yet. And so, be patient with some of these claims. If you do have a legitimate claim, make sure that just be patient with them, follow up on some things. But let's get in mind of what's dragging this out. Why is the IRS having so many issues? And it's because of these frivolous claims that these third parties are putting out there. Again, they're calling everyone under the sun. If you have a registered LLC in the state of Texas, that is open information for these companies. They can literally just go out to the state of Texas website and pull a list.
Yeah.
And start calling people.
And what they really need to do, and I'm sure the IRS will at some point, but these preparers, and they're just kind of popping out of the woodwork out there, right?
Yeah.
They're just saying, hey, we're specialists in this ERC credits.
Yep.
They're not specialists, Rick. We know that. They're good at marketing. They advertise very well. And they're very aggressive. They're very aggressive in their positions, and they don't care.
No, absolutely. Yeah. And then that's the other thing is taxpayers need to be aware that these specialists, these ERC specialists, they charge a fee for preparing these things. And if they prepare a return or an amended return for you to claim the ERC credit and you do not actually qualify, you don't get your money back.
No, you
right?
don't. And a prime example, let's just say they amended the payroll reports and it shows you get a $1 million ERC credit. And they said, hey, you're going to pay us a 25% contingency based off of that. Well, once you've paid them that $25,000, the IRS still says, no, you don't qualify. Or $250,000, you're not getting that $250 back, Rick. It's gone.
Right, because many of these companies, the fine print says it is ultimately the taxpayer's responsibility to determine whether or not you qualify or not. They take no liability when it comes to filing these things. They are simply just trying to get you money if they think you qualify, but they don't have the actual due diligence to go through to determine whether or not a person or a business should qualify for it, right?
And you got to watch out, right? So they're popping up overnight. They're highly compensated, right, by the end result. These are contingency deals, and that I say they're contingency on what the payroll reports say, but not actually you receiving your money from the Internal Revenue Service.
That's right, because it's more than just the payroll, right? So if you go back to the three-pronged test that's out there, it is, did you have a substantial drop in revenues, right? And so for that first year, it was a 50% drop. You had to have a 50% drop from 2019 to 2020 in any given quarter. Now it's on a quarter, not an annual basis, right?
Yep.
On a quarterly basis, quarter to quarter, did you have that drop, right? And so then for 21, it was an 80% drop over that same time period, right? Now, if you are a brand new business, there were some new rules, right? Like if you started your business into 2019, beginning of 2020, and you didn't have those quarters, there's rules in place for which periods you compare, but you still had to follow that 50 and 80% rule, right? And that was just to determine whether you qualified,
Absolutely.
right?
Absolutely. Yeah.
And then the second thing was you actually had to run payroll. How many people shut down during this period, didn't run payroll, but seemed to think that they earned this credit, right?
It was crazy. And a lot of it was just bad information that was out there.
Right.
And so people deciphered what they thought was reasonable. And then, like you say, a lot of frivolous preparers out there.
Yeah, and this was no different than the PPP stuff, right?
Absolutely.
I mean, how many people have we heard now they're going to jail for improperly claiming PPP? They set up fake companies, fake employees, just so they could get free PPP money.
Yeah,
and this is not small dollars. We're talking millions of dollars that was funneled into these fake businesses.
Absolutely. I mean, this gets us back to know who your preparer is.
Yeah,
know the people that are doing your work. Look, you're not going to get one over on them. Very quickly. It's just not going to happen, guys. Let's keep things in perspective, I think is the most important thing here. Rick, the Augusta rule.
The magic rule.
The Masters Golf Tournament is where it had fostered off of Internal Revenue Service Code 280 AG. You want to talk about a little bit about the Augusta rule?
Sure. Yeah. So this is my favorite rule that my real estate investors love to pull up. There's they all hear about it. They go to these conferences. I'm gonna get to rent my property out for less than 15 days, and I don't have to pay anything, and I can charge exorbitant rates for this, X, Y, and Z, and and it's not the case, right? So, one of the things that I always tell people is, one, the Augusta rule was set up, if you go back to it, it was set up for homeowners.
Yes.
Homeowners, not rental properties, homeowners.
Yes.
Who owned property on the golf course and wanted to be able to rent it out during the Masters to people that were coming in, but didn't want to have to pay taxes for a short-term rental, right?
Yep.
And so to qualify, you have to be a homeowner first, not a real estate investor.
That's correct.
Okay? It has to be your own personal home that you are renting out less than 15 days out of the year, right? 14
days, exactly. And, the key is, and like you just said, it was for the Augusta of the golf tournament. You probably, if the IRS wants to come back and question it, you probably need to be where there's a venue or something that someone would want to go to that area and rent that out, right? There has to be a reasonable business purpose, guys. I say this all the time. You just don't go create a company or go create a deduction without having a legitimate business purpose. And that was the whole purpose that the Internal Revenue Service Code had instituted here on the Augusta rule, was that it needed to have a business purpose.
That's right.
And that was the whole driving force behind that.
Yeah. And so one of the things that Jake and I recommend is, if let's say you're a business owner, right? And you have a nice home and you want to rent your business, you want to rent your personal home to your business, you certainly can do that, right?
Yeah.
But there has to be a legitimate business purpose, right? It just can't be, I'm going to write myself a check and call it rent.
Exactly.
I need to have some kind of employee meeting there.
That's right.
I need to,
a lease agreement might be nice in place.
Yeah. Maybe you're doing team building with your staff, right? And you have a weekend that you bring them in and they spend the weekend at your house and you do team building. You have some meetings. Maybe you're doing, hey, we're at the end of the year. Let's look at next year and do some projections on next year, right?
Yeah. And I think the one thing that's key too, Rick, is it needs to be an arm's length agreement, right? It needs to be, what the market rate is, per se. You can't just go say, hey, I'm gonna, charge $10,000 a night, right? And write off, $140,000, and that's just not reasonable based on market conditions.
Correct.
Right. So it needs to be an arm's length agreement. It needs to be whatever market rate is, per se, and you got to have a legitimate business purpose. Okay. If you don't, good luck with that. I wouldn't want to be one that's representing my client under those conditions.
Yeah, no, it's where we see people get in trouble is those things, right? It's the using an unreasonable market rate.
Yes.
Or not even really having a business purpose, right? I just write myself a check out of my business and say, I'm reimbursing myself for rent that's going on because I'm going to rent my house out. Yep. But I didn't hold a meeting there. I didn't use it for the business. I didn't even have a party, right, with my employees, right?
Completely illegitimate, exactly.
Right.
And I think the key is the reason we're doing this podcast, Rick, is there's a lot of good information out there that a lot of people are talking about, like the Augusta rule. However, they're very vague. They're not telling you that there could be potential pitfalls. They're just saying, hey, go ahead and write off, 14 days of your house. They're not telling you, make sure you have a legitimate business purpose.
Yeah.
They're not telling you it needs to be at a market rate, right? They're not telling you to have these lease agreements in place. And if you don't have those and you are, selected by the IRS, it's not going to pass muster, guys. I'm just being honest here. Okay. So that person who's giving you advice, I wouldn't listen to them. You need to make sure, yes, you can do it, but you need to make sure these things are lined up properly.
Yeah. I mean, you and I have explored doing this with our own personal residence, right?
Yes.
And I think at the end of the day, we both agreed maybe we could get away with it doing a day or two, right?
Yeah.
But it's not like
we haven't even done that.
Right.
Yeah.
No. Because at the end of the day, it's really hard to justify 2 weeks being in your own personal residence.
Yeah.
Right. And that's what the IRS is going to look at is, this is supposed to be your personal residence. Did you really give it up for 2 weeks?
Yeah. Even to the sense of maybe you produce some flyers or something like that showing they're renting it out during this time frame.
Yep.
The reality is most people don't go to those links.
Yeah.
And I would bet you if the IRS is looking to bust that rule up, it's going to be fairly easy.
Yeah.
The thing that comes up that I hear all the time is, hey, Rick, I want to use my personal vehicle for my business. What's your thoughts on that?
My thoughts are be careful, right? Be careful.
Yeah.
This is probably the most common thing that everyone wants to do. They think, I'm a business owner. I'm using my car in my business. I should write that car off, right? Well, you can. You absolutely can. But you have to be able to demonstrate a few things. Did you actually use it in the business? And was that actual business use, or was it commuting, guys? Because that's where we always fall in that trap is,
Yep.
I've got my office, it's 30 minutes from my house, and I'm driving to my office.
Well, yeah. And the slippery slope that I always see in that is a lot of people use their business car for personal reasons too. Right?
Yeah.
And so you can't take 100% deduction for that. And I love this when we talk about depreciation, because the first thing I hear everybody on TikTok or YouTube Shorts or whatever, the first thing I hear is, oh, we just depreciate, so no one ever pays taxes. Okay, so let's talk about that myth about depreciation, okay? Depreciation, no matter if it's a vehicle, whatever it is, at some point, it's what I call is nothing more than a timing element, right? It's a deferral. Mm-hmm. It's not a true deduction. It is a deferral. So it's not like a tax savings. It is a deferral that at some point, when you sell that vehicle, right, or you remove that vehicle out of the business, you have what they call recapture.
Yeah, and that's
okay.
That's income now.
That is now income, okay? And no one seems to say that anymore, right? They say, oh, no, it's just deduction. Just depreciate. How many people come to us a year ago, should I buy a vehicle, Rick?
Well, and I'll give an example. I just had this call yesterday with a client. She bought a $120,000 vehicle last year. She used the bonus depreciation that she could write off all of it. And then what happened? She didn't operate that business this year.
Yep.
She didn't operate that business this year. She didn't use that vehicle in year 2. Mm-hmm. And so now she wanted to know what's going to happen. And I said, well, unfortunately, you're going to be subject to depreciation recapture, because what that means is we've over depreciated in year 1 that vehicle that you're now no longer using in a business. And the IRS goes, wait a second. Mm-hmm. You said you were going to use this vehicle for 4 or 5 years, and now you haven't used it again. We need to pull some of that back. And so now she's going to get hit with tens of thousands of dollars of phantom income, right? Mm-hmm. That's mm-hmm. what that is. It's phantom income that gets added back to your tax return. And what if you made more money this year than you did last year?
Now you're in a higher tax bracket.
And now I'm in a higher tax bracket, and I'm paying a higher tax on that phantom income than if I hadn't accelerated the depreciation in year 1. Now, I'm not advocating that we don't take a deduction if we can take the deduction, right?
Sure.
But you have to be aware of these things, because if your business grows, which is what every business owner wants to hear, is I'm going to make more money this year than I did the year before, right?
Yep.
Well, what happens when you make more money? You push up those tax brackets, those deductions become less and less valuable to you because you're pushing those higher tax brackets. And so if we've accelerated depreciation in year 1, well, I'm not taking that depreciation in year 2 when it might have meant more in tax dollars to me.
Well, and what we also need to look at when that occurs as well is the potential state or county filings that have to occur as well, right? So if you register that vehicle now in your business, depending on what county you operate in, now you have property or vehicle rendition reports you have to pay.
That's right.
Right? And if that value is greater than $20,000, now you're paying rendition taxes on that as well.
That's right.
And a lot of people just look at it from a federal perspective, but there's so many different variables when you're making these determinations. And the one thing that I always kind of hang myself on with every client when they say, what's the most tax advantageous? What's the best thing to do is to buy a vehicle or lease a vehicle. And I always say, well, you should never make that decision based on the taxes alone.
Yes.
There's so many other variables you should factor in.
Yeah.
And people, for whatever reason, they go, well, let me just talk to my CPA. Let me just talk to my EA. Let me just see what's the most tax advantageous. And I'm sorry to say this. This is what we do for a living. That should not be your sole decision-making on whether to buy a car or lease a car.
No, absolutely. Yeah. Because one of the things I always have to explain to clients is they think I'm getting this $100,000 write-off, right?
Once again, a timing element. That's all it is. It's a deferral. Yeah.
And they think,
recapture.
And they think in their minds, they're thinking that's $100,000 of taxes. And you have to explain to them, no. That's just the income you're reducing.
That's it.
Right? So if your effective tax bracket is 19-20%, yeah, you're saving $19,000, $20,000 by buying that $100,000 vehicle, right?
Correct.
But that's one of the things that you have to think about is, do I buy this $100,000 vehicle because I really want it? Well, if you really want it, then buy it, right? But if you're buying it for a tax break, is spending $100,000 in cash, either out of your personal or your business, worth saving $19,000 to $20,000 in your business? I mean, just from a cash flow perspective, does that make sense? And most of the times, I argue, no, it doesn't.
It doesn't. And you need to look at, like, if you're going to lease a vehicle, what are the miling constraints associated with that?
Right.
A lot of times you're penalized if you go over 12,000, 15,000 miles. How active are you going to use the vehicle? How often are you going to get a new vehicle? What's the rate at which vehicles are going up in value? There's so many different variables, Rick. You know that.
Yep.
But unfortunately, clients just don't see that. Okay. So there's one topic I want to talk about. Okay. And this is new for you and I both.
Okay.
This is the Corporate Transparency Act, which is going into effect on January 1st, 2024. And I'm not sure we have all the right information out there right now either, but I just love to kind of kick things off and talk about it.
Sure.
Right now, the IRS is imposing new federal filing requirements for most corporations and limited liability companies formed in 2024 and later. Okay. The CTA's purpose is to prevent the use of anonymous shell companies for money laundering, tax evasion, and other illegal purposes. But it applies to honest business owners as well as criminals in this situation. Okay, the CTA does not apply to all new businesses. It applies only to entities such as corporations, LLCs, and other formed by filing a document with the Secretary of State or similar official. It does not apply to sole proprietorships. Rick, you want to talk about some of the different businesses that are exempt from this?
Sure. So this is going to not apply to your super large businesses, okay? Your $5 million and above in receipts, that type of thing. Now, take it for what it is. They're going to have other filing requirements.
Yes, they are.
Okay.
Yes, they are. So
they're not subject to this. There's another law that the large business owners are going to have to follow, and it's a lot more paperwork, right? So just so you know, just because you're a small one, don't think, well, I'm being punished and the big ones are not. No. Everyone's getting punished with this,
guys. And here's the deal, right? I know everybody likes to go, and the reason I say this is because we see this all the time. I know everybody likes to go on LegalZoom or one of these online websites, create their businesses, and we see that all the time. And that's okay. If that's what you want to do, that's fine, whatever. I don't agree with it, but it is what it is. Where it's going to hang you guys is if you're not communicating with your CPA, your EA, your tax preparer, whoever that person is, to make sure they have all the relevant information so they can make sure that they're filing necessary forms. It's going to change in 2024. Yeah. We see this all the time. So many of our clients just decide they want to go rogue. A little bit of information can get you into a lot of trouble,
Yeah.
And then, we're at filing for our clients, and they'll say, well, Jake, Rick, I created this other company. We had, unbeknown to us completely. Well, there's penalties that now can be associated with some of these by not filing them ahead of time.
Yeah, that's correct. So, just to piggyback off of that, starting in 2024, if you start a new business, an LLC, a corporation, whatever, you have 30 days to complete this form. Okay. Mm-hmm. And get it into both the IRS and to FinCEN. FinCEN is the government agency that regulates a lot of the, fraud, the currency frauds and things like that. They are the ones that we have to report all the foreign ownerships to the banks that you might own in other countries and whatnot. But so, we have to file these forms 30 days after you file that LLC formation document, right? And if you already have an LLC, you have until the end of next year to file this form as well, right? But everyone has to file it. And here's the other thing.
Last time I saw what was like $200 a day or something like that, up to $10,000.
It's up to $10,000
per partner.
Per partner, right? So here's the thing: Jake starts a new company in 24. And then he comes to me in April and says, "Hey, Rick, you want to partner with me? This thing's going great." And I'm like, "Sure." That LLC just had a significant change to it because you just added a partner to it.
That's right.
Right?
That's right.
Guess what? You have 30 days to report that change. Even though you've already filed the form previously, you have to make an amendment within 30 days, or again, be subject to these penalties.
Guys, here's the deal. This is where it harps on making sure that you have the right people, the right team in place, the right accountants, the right attorneys, whoever is going to be doing these filings, and everybody's on the same page, right? So you can't just go say, "Hey, I hired the right attorney to create the documents, right? Form the company," and then they don't communicate with your CPA or your EA or whoever your preparer is. Everybody has to communicate well. And if you decide you're going to go rogue and do all this on your own, and you're not going to communicate properly and have the thing set up, it's going to cost you more money in the long run.
Right. And
now you're going to be under a lot more scrutiny because the IRS is going to look at you and say, "Well, you didn't file these proper forms for FinCEN purposes. We've now assessed you up to $10,000 in fines. Should we still look at you under scrutiny?" Because there's a reason. Either you don't know what you're doing or you're trying to do frivolous things. Either way, you're still looped in with those individuals, and now the IRS is looking at you with greater scrutiny.
That's right. That's right. You could absolutely, if you have multiple businesses, messing up on one could drag the others into the spotlight, right? And so this is where, as Jake said, it's very important that you're communicating with the people that are doing your tax prep, your attorneys and whatnot. Make sure that the documents are getting filed. This is only going to get worse, guys.
And guys, I'll tell you this: if we handle your stuff, right? This is not a sell, but this should be a sell, and this should be any legitimate accounting firm should operate like that. If we're the ones that are creating your documents and getting everything ready for you, if we drop the ball, we'll pay your penalties for you.
Yeah.
Okay. And any legitimate company would do the same thing.
Right.
Okay. So that's worth its weight in gold, right there. Is what I would think.
Yeah, absolutely. And that's why we harp so much on having client meetings regularly throughout the year.
Absolutely.
Because if we're having these client meetings and the clients are coming in and we're going, "How's it going? What's new in paradise?" Right?
Yeah.
And you go, "Oh, I just started this company. Great. Let's get on that. Let's get the filings done." Right? Because
it took us years, Rick, as we started our firms respectively 10 plus years ago each. And then before we merged, you're trying to figure things out, right? And it would happen to us all the time. And there's got to be a better way. And that's what we do. That's why Rick and we push so hard on our advisory here, is because the more we know, not because we're trying to get in your business, the more we know, though, the better advice we can provide to you,
That's right.
the more value we add to you, the more it's worth.
Yeah.
Okay. Man, the hobby loss rule, Rick. The hobby loss rule. You got to be very careful. I see this all the time with people who try to run hobbies as legitimate businesses. You've probably seen these golfers that go, "Hey, Jake, I shoot in the low 90s, high 80s or whatever. There's some little tournaments. Can I go write off all my golf?" And you can't, Rick. You can't. You want to talk about the hobby loss rules and things that are associated with that?
Yeah. So what this really reflects is the IRS is aware that people try to legitimize a business interest around what really isn't a business. Okay. Mm-hmm. And so, a great example, right? I like drinking a glass of wine. Right?
There's nothing wrong with that. Yeah.
And one of the things I would love to do.
You had a nice glass of Moscato yesterday.
Yes, actually. I did. Yeah. I want to build out a nice winery. Do a basement.
Sure.
Build it out.
Sure.
Right? Have a nice little thing. Could I make a business out of that?
It's more like a hobby.
It's a hobby, right?
Yeah.
Now, could I legitimize it and go, "Yeah, I'm going to collect brands and then I'm going to turn around and maybe sell a couple of bottles here and there to people"? But ultimately, if I'm not in the business,
mm-hmm.
if I'm not in the business of buying and selling wine or making wine and turning around and selling it, having a distillery and all that, if I'm really just for my own personal purposes setting up a nice wine cellar, it's a hobby. Mm-hmm. Okay, I can't write the build out of that wine cellar out, right? But we see this all the time, right? I really am interested in this one thing, and I think I can make a legitimate business purpose out of it, but it's really just for me. Right.
Yeah. I mean, let's look at it like this. Let's just say, for instance, Rick, you get this kicked off and you make $200,000, right? But to build out that wine cellar, your investments for your inventory, everything, you got $350,000 in it. Guess what, guys? It's still a hobby. But Rick's got to pay taxes on the $200,000 in income.
Yeah.
Okay. He didn't get any of the deductions that's associated with that because it was never a business intent. It was a hobby intent. So you need to be very careful when someone just says, oh, hey, this is a hobby. Can I use this as a tax sheltering vehicle, right? To offset other sources of income, okay? You need to be all in business. If you're going to be a business owner, you need to be all in. I would tell you, this 1 foot in, 1 foot out on key subject matters, right? That, same thing goes for horses, right?
Yeah.
Everybody wants to buy their kid a horse here or there or whatever. But you got to be very careful on that kind of stuff. It has to be a true legitimate business purpose.
Well, and I'll give you another example. I went down to a trading card company this weekend, bought a box of baseball cards.
Yeah.
Right. And I'm going to start collecting different sets and things. I could turn around if I collected a set and turn around and sell it. And I could actually, in theory, make a business out of that.
Yeah. Yeah.
But
a lot of people do.
But is it a business or is it my hobby? Right. And it really comes down to your intents and purposes. Are you running it as a legitimate business? Right. Are you out actually actively working that business? Or is it something you do once every 3 or 4 months? Okay.
Yeah.
How much time are you devoting to this?
When I've seen people that run these businesses, they'll go on Facebook and they'll have these drawings and things like that. You see what I'm saying? Everybody will pitch in, or they'll have their own website created with all their stuff on it. Now, those are legitimate businesses they're trying to run.
Yeah.
Okay. And so, you just got to be very careful. And I think that's what we're trying to
absolutely
convey.
Yeah.
Okay. We're all for people trying to run business, and look, we realize not everyone's going to be successful, and I think the IRS realizes that as well.
Yeah.
But your intent matters the most.
Yeah.
Okay. Your intent matters the most. Yeah. Good information. So let's talk about what you can have in your real estate portfolio, whether an investor, a dealer of properties, and the distinctions associated. As an example, here's a snapshot of some potential tax differences. As a dealer, your tax could be $46,017. As an investor, it might only be $21,420. Now, Rick, what would be the difference between that? One is an investor, so we could be potentially be looking at long-term cap gains on something, right? If you're a dealer, this is active income. You're actually actively working in the business, right? So it's going to be taxed as ordinary income. Yeah. So guys, you got to be very careful, right? When you're talking about real estate, are you an investor in that real estate? Or are you an active trader? And what I see this all the time is people buy a house and they flip the house. Yep. Okay. If your intent was always to buy that house and flip that house becomes a cost of good that you're basically selling. That's going to be taxed as ordinary income. However, let's just say you bought a house and you decide to rent it. And you start to rent it, and you maybe rent it or fix it up, and you hold on to the property for a year. You're not too successful in the rental. Well, your intent was always to rent it. So then you'd have rental income, right? But then when you sell it, if you've had it for now over a year, you've now changed your intent. So now you're an investor. It becomes capital gains at that point, and it's going to be taxed at 20%.
Yeah.
So it's all about your intent, guys. Okay. Look, we know, the IRS knows, everybody wants to be taxed as an investor. But if you don't set things up properly, it's real easy for the IRS to come back and bust those transactions.
Yeah.
So be very careful. Rick, do you want to talk for a second about the Affordable Care Act at all? Do you know much about that? HSAs.
Yes.
This was a subject matter we kind of, I guess we spoke about the other day, but I know we just got past tax season and everything. If you want to kind of hit on a couple key subject matters about the contribution limits and things of the such.
Yeah. So, ACA, formerly known as Obamacare, 2018, that all went away as far as reporting requirements for your health insurance under the Trump tax laws. Those are set to expire in 2025.
Yeah.
Right.
Yeah.
So unless there's an extension of those things, the Obamacare requirements will come back into place at the end of 2025. So just be mindful of those things. Now, I can't predict, you can't predict what's going to happen in the next 2 years. But it is something that's out there. Now, as far as, how do these plans work and what are some things we can talk about? The one thing that we see a lot of times is people come in and they've got a group plan with their employer, and maybe the employer doesn't have a cafeteria plan or an HSA or something like that allows them to defer some dollars on a tax-free basis to help support those things. And they come in, can I set one up, right?
Yep.
Can I set one up, and can you do that? Well, no, we can't.
We can't.
We can talk to you about whether you qualify for one, though, right?
Sure.
So let's talk about whether you even qualify for setting up your own HSA, or if you've got an employer and they are offering an HSA, whether you qualify for that plan, right? And so the HSA is for people that have high deductible health insurance plans, right? And so what is that? And if I'm recalling the rules correctly, it is the plan is $1,500 deductible.
I think that's the minimum. Yeah.
And so if your minimum deductible, and that's on an individual basis, not on a family basis, if your individual deductible is $1,500 or more, you qualify for an HSA. Okay.
Yep.
And you can contribute up to $3,850 to that HSA, or $7,750 for your family in 2023, and they'll go up in 24. They always do some kind of adjusted GDP inflation adjustment.
And if you're 55 or older, they're going to give you an extra little $1,000 kick.
Correct. Yeah. And so what does that do? Well, that means that, whether it's through your W-2 or you're putting after-tax dollars in there that you're then going to take a deduction on your tax return, you can put this money aside into this plan, and it's kind of like an IRA.
Yeah, kind of. It just allows you to utilize those funds towards medical expenses.
Yeah, they have to be qualified now. Qualified medical. Yeah, and to be honest, there's the qualifications pretty generous.
They are pretty generous. Years ago, though, I know that people used to abuse it a lot.
Yes,
they would run vitamins through there.
Yeah.
Now, look, there are certain vitamins that you can deduct. Okay. They have to be prescribed by your doctor, though.
Correct.
Okay. You got to be very careful about that. You can't just go. And there are certain weight loss supplements you can take too, as long as it is prescribed by your doctor.
Right.
Okay. You got to be very careful. When it comes to things that are cosmetic, though, no, they're not going to cover that.
Correct. Yeah.
You got to be very careful on that as well.
Most of the time, people are using them for the co-pays.
Yeah.
Right.
Yeah.
I need to go get my dental or my vision taken care of, and those are legitimate. You go down to CVS or Walgreens and I need to buy some solution for my contacts and things like that. Usually those things will actually qualify. Okay. It's where you kind of get into buying groceries and other things with your HSAs that kind of get you in trouble. And so it's on you from a record keeping standpoint of keeping the legitimate receipts for everything. But this is a way that you can defer money on a tax-free basis and then spend that money throughout the year on things that you and your family need for health reasons, right? But you got to meet that high deductible insurance plan, which, let's be honest, most employers, $1,500, that's about right for most of them.
Yeah, it is. It is. Rick, I want to go ahead and take a break now, if you're okay with that.
Okay.
I've enjoyed this, and let's circle back here in just a few minutes.
Perfect.
Take a little break, okay? Awesome. Thank you, guys. See y'all in a little bit. All right, man. Well, great little break. One of the questions that came up the other day by one of our clients was, can you deduct the cost of real estate seminars and boot camps? And I think it gets back to what we talked about is this an investment or is this a business?
Yeah, no, it's, the answer is it depends, right? It really depends on how do you classify yourself?
Yeah.
Are you an investor? Are you a realtor? Are you a dealer?
What are you?
What are you, right? Because each of those has a different way of deducting the cost of these things and what you can and can't do, right?
Yeah, and in most situations, if you are in the aspect of flipping homes, right? You are the business owner. Then typically, yeah, you can deduct most of the costs associated with that.
Right, because you're running a business.
That's right. That's right.
Rental properties in and of themselves, while we run them through LLCs and all that, are not active businesses. They're passive activities.
Correct.
Right. And so therefore the deductions you can take are solely related to the property themselves, not what things you do. Right.
Mm-hmm. That's correct.
So if you're a realtor, absolutely. I go to a boot camp. I go on, my favorite one is the CPE by the sea. So you take a cruise and you're getting your certification, education credits while you're doing it. As a realtor, absolutely. That's a deduction as long as the purpose of that is for you to get the education while you're doing that. But if you're an investor going to a Grant Cardone investing seminar, while that's great, it's not a deduction.
No, it's not. It's not. Hey, great thing you brought up here about going on the cruise and all that good fun stuff. One of the things that just kind of popped into my mind, it's not necessarily related to the subject matter, but it's all about us producing the right content and giving our clients or prospects just good information out there. Partnerships versus like other pass-through entities like S corps, right? So let's just say, for instance, Rick and I, right? We have an LLC, okay? We have an LLC that is taxed as an S corp, okay? But let's just say we were taxed as a partnership, and Rick has continuing education he has to go to. I have continuing education I have to go to as a licensed professional. Yeah. And Rick comes to me and says, "Oh man, Jake, I want to go to Vegas to go do my CPE." And I say, "Well, that's awesome, but I did mine right here in Houston, and I don't want to pay, right, for you to go to Vegas." And Rick goes, "Oh, come on, man. Let me go. And I go, "Rick, you can absolutely write that off because we're an LLC tax as a partnership, right? But Rick will write that off, and Rick will bear the cost, and he'll write that off as what we call an unreimbursed partnership expense, a UPE. And so what happens is, as the K-1 rolls back to the taxpayer on their 1040, there will be a separate line item on Schedule E, page 2, that is only deductible for Rick. Now, if we're an LLC tax as an S corp, we both have to agree on that.
That's right.
Okay, and so it's very key. And one of the areas we'll discuss, maybe not right this second, is how to make sure your entity is properly set up and what is the best classification for you. Okay. Realize whatever your buddy's classification is or his sister's classification is, and depending on their industry, that doesn't mean it's right for you.
Right.
Okay. And so one of the things that's very key for us is when we bring clients on board is we try to learn as much about the client and what their expectations are, what they're trying to accomplish. And then we try to fit with them the right entity formation. It's never a cookie cutter, no matter what anyone tells you, right? And then today, we might be an LLC tax as an S corp. Tomorrow, we might decide we need to form a new C corp.
Yeah,
it's more tax advantageous at a 21% tax rate. Things change, right? Your business changes, and you must evolve with your business. Very important.
Yeah, and that's why it's very important to have the right professionals around you. Right. Because I can't tell you the number of times I've had a client walk in and tell me, I've had the same person for 10 years and we only see them one time a year to do our taxes, and I never get anything out of them.
Yeah.
They know no education, no advice on what I should be doing going forward. And we come in and we look at it, and they've overpaid taxes year after year after year by making a simple tax election here.
Yeah.
Or setting up an entity there that could have saved them tens of thousands of dollars every year.
Yeah, guys, if you aren't sitting down with your CPA, your EA, your tax professional at least 2 times a year, then you need to. And if they can't do that, then you need to find someone who can.
Yeah.
Look, guys, it's going to cost money, but if you want to do things right, and you want to grow your business, and the terminology I always like to use is, if you're not progressing, you're regressing in life.
That's right.
Okay. And with inflation, so if you do, $200,000, $300,000 20 years ago in revenue, and you're still doing $200,000, $300,000 20 years later, time value of money, you really haven't grown. right? So you need to be with the right team.
That's right.
And I can't emphasize that enough.
Yeah, no, and that's everything. The right attorney, the right CPA or EA, the right financial advisor. You need to have a team around you.
Business coaches,
yes,
too?
a business coach,
A CFO.
Yeah, there's a ton of, we call it the team. It's
Yes.
the team approach, and we are one cog of that team.
Absolutely.
Right. And so what we try and tell all of our clients is, if you're serious about your business, serious people hire serious people.
That's right. That's right. If you think about it, you know me, I love sports,
Yeah.
right? And so, and anyone who is a sports fanatic, whether it be baseball, football, basketball, whatever the sport is, right? You have coaches, you have team members that help get you to that next level, whether it be about your nutrition, whether it be about your sleep habits, whether it be about the supplements you take, whether it be about the certain types of practicing that you do, right? Iron sharpens iron. So if you're serious about business, you need to get with serious people.
Yeah.
It's not a sell, it's the truth, right? And so, I can't emphasize that enough. So we just hit a little bit on different entities, Rick, and one of the areas I want to touch on is if you operate your business as a C or an S corp and you decide that you're going to loan money to a corporation, or the corporation loans money to you, and do you need to document the loan or its intent?
Yeah, that's a great example, because this is one of the things that from a tax strategy we implement all the time with our clients is setting up an S corp and or a C corp management style corporation that handles things for your business. There are some great tax advantages to doing that, but it all comes down to the paperwork.
That's right. And we always talk about, when we're going to set these C corps up, what is your intended purpose, right? And so oftentimes what will happen, this will almost be like a staffing company, right, that handles all your payroll, and you run all that through that company, because you can't just redirect. It's called transfer pricing in a sense, more on an international basis, but you're transferring to a more tax beneficial system. And it's okay to strategize. It's okay to plan, but you still have to have a legitimate purpose. And if you're going to loan money to your corporations, or the corporation's going to loan money to you, you need to make sure you document things appropriately.
Yeah. And so what are the consequences if I don't paper that thing?
Tell me, Rick, what are those consequences?
Well, so I can tell you real quick. One of the things that we see all the time is I set this C corp up, and it's my management company, and I've moved money over for management fees. Right now, I got all this money sitting over in the C corp. What do I do with it? And I'm just going to take money out of it, but I don't want to pay taxes on it, so I don't. It's not a dividend. I don't want to pay the double taxation. I'm just going to loan it to myself. Right? Did you document that?
You need to.
You need to document it.
Yeah.
Okay. And do you have an intent to repay the loan?
That's correct.
Because if there's no intent, and intent is justified by the actions that preceded it, right?
Yes.
If there's no repayments set up, the IRS comes in and goes, that wasn't a loan.
Nope.
You just tried to circumvent wages and pulled money out. We're going to treat that all as payroll. And now you have back payroll, penalties and interest.
Yep.
Income taxes on that payroll,
Yep.
penalties and interest.
Correct.
And that loan just became a very expensive loan to you, because you probably lost 30-40% of the money that you borrowed out of the company because you didn't document and do what you should have done. Documentation
is key. It is absolutely key. If you don't document, how do you substantiate under an audit? You and I have represented so many clients over the years, Rick, for audits. And I can tell you the first thing they ask for is documentation, okay? Oftentimes, depending on the audit and the severity of it and what's going on, they'll conduct an interview because they want to make sure with what you're documenting, do your stories line up, okay? But it's all about documentation. You can say whatever. Well, this was my intent.
Yeah.
If you don't document things properly, even if we're looking at mileage, right? You need to document. There are apps out there, right? That if you are driving a certain amount of business miles, you click the app on your phone and it documents the mileage you're doing. If you don't properly document, good luck substantiating that mileage on there, right? Same thing goes with you're getting your oil changes, your third parties that are validating the mileage that you have that ties back to your schedule. If you don't have that proper documentation, it will not pass muster with the IRS. Been there, done that too many times. and clients just keep poor records. They get sloppy.
You know, you're talking about this, and it reminds me of our business documentation and operations coaching that we do with our clients.
Yes.
And that is, it's part of our advisory services that we include here. And it is a 80 slide presentation
It's
that
fabulous.
takes
Fabulous.
solid 3 or 4 hours to go through. And I can't tell you the number of clients that have sat through that presentation and have gone, I never knew this.
Yeah. And guys, here's the other deal. Once you educate your clients on it. So I would recommend anyone, hey, if you're interested in this, get with us. We'll go over it with you. Happy to. It's so informative, well worth the money, not that expensive at all. And then if you get to the point, hey, you're going to utilize some of this, either you have to keep great records or you need to pay someone to keep those great records, okay? But those records need to be done. And it gets back to what we talked about at the beginning of this podcast, that you got to have the right team around you, right? You got to make sure you have the right people in your corner doing the right things. Because if you don't, you're trying to do things fly by the seat of your pants. It's not a matter of if they catch you, they will catch you.
Yeah. And let's be honest, it's not just the IRS you have to worry about.
No.
It's the legal side of it too.
That's right.
People think I have an LLC, I'm protected. But are you though?
They could pierce that corporate veil.
Very easily. If the documentation isn't there
That's right.
to substantiate the legitimacy of that LLC and the way that you're running it, suddenly that LLC is gone. And guess who's on the hook for everything?
You are. And here's the deal. Look, we live in a very litigious society nowadays.
Yeah.
And I wish it wasn't this way, but it is what it is at the end of the day. If you're not protecting your butt, I promise you, someone's coming after it. The higher you gain on the post-auction, the more success you have, the greater wealth that you accumulate. You're more of a target now for some of these people, for these frivolous lawsuits they're going after.
Absolutely. Absolutely.
Okay. And so having the right team members in place, protecting you from the front end. This is the analogy I always tell people, right? You can be building this big elaborate business, this big elaborate mansion, right? But if you don't build it on a solid foundation, the first time a storm comes through, it's going to blow all your hard work away.
Yeah, absolutely.
Okay. So sometimes you got to slow it down. You got to make sure you have the right things in place and the right team members to get you where you need to be.
Yeah.
So many of our clients, Rick, have taken opportunities to live and work abroad, right? Such as Switzerland and other tax havens, right? I know the one that's come up real big right now that I did some research for one of our clients is Puerto Rico. Okay. I actually wrote an article on Medium the other day and it talked about Jake Paul. Everybody knows who Jake Paul and Logan Paul is, and they live down in Puerto Rico. Does anyone know why they live in Puerto Rico? Do you know why they live in Puerto Rico?
Because they don't pay taxes.
So they don't pay very much in taxes, right? That's correct. So they have to live down, for Puerto Rico purposes, you have to live down there more than 6 months, right? So it's 183 days.
Correct.
Okay. Or an average of 183 days over a 3-year period.
Yeah.
Okay. And then all your sources of income in that area while you're under Puerto Rican taxes, and a lot of it, their business is taxed at like 4%. Interest, dividends, cap gains is 0. It's a tax haven, but it's very, very important, right, that you follow those rules to a T.
Yeah.
Right. Look, the IRS understands what you're doing, right? You're not pulling one over on them, but you want to make sure you're doing things the right way, okay? And if this is something that you want to do, if you want to be the next Jake Paul, you want to be the next Logan Paul, and you decide, hey, you know what, I got a podcast, and I'm making all this money on YouTube, and I want to not give away as much to Uncle Sam. Well, that's fine, but how you live is going to change.
Yeah.
Puerto Rico is a beautiful area. They do get hit with a lot of hurricanes down there, though.
Yes, they do. Yes.
But anyways, you need to meet with the right professionals
Yeah.
to make sure that you don't to break that.
Yeah. Yeah. And I'll piggyback on that. One of the things, we've had a client that has done this and they thought they qualified under the rules. And my first question to them was, how much time did you spend here in the U.S.?
That's right. That's right. Here's the deal also, guys. If you happen to have a foreign bank account, so let's just say it's not Puerto Rico. Let's say it's Canada. And you know this, I have a house in Canada. Mm-hmm. And so me and my business partner, we have a bank account in Canada. Guys, if you have a bank account in another country and you're a U.S. citizen, you have to file an FBAR report. every year, and you have to report on there what your largest amount in that bank account was for the year. And you have to report that every single year. So be careful when you're moving money around other countries and things of the sort.
Yeah. Because
you have a filing requirement. You are a U.S. citizen, and they want to make sure that they know where every dollar is all the time.
Yeah, yeah. And that rule actually has changed in the last couple of years, because it used to be somewhere around $10,000. As long as you didn't have more than 10 grand outside in a bank account, you didn't have to report. And those amounts have come down year after year, because they realized that what people were doing is opening multiple bank accounts and just shuffling small denominations out between these different banks. And so they've lowered it to the point where almost anybody that has a bank account has to report now, because they want to see where that money's going.
That's right. That's right. They're trying to make sure that, things aren't used for terroristic states, money laundering, things like that.
Yep.
That it actually has an intended purpose. And in my situation, we have a house up there in Canada, and we pay our expenses to the business up there. So
sure.
But we have to report that. You have to report that, guys. Man, this next topic I want to talk about, this is a great one. And it's often seen in houses or real estate per se. The distinction between repair expenses versus capitalized expenditures on the house. If you decide, hey, I'm putting a new floor in, but my floor was okay, I just wanted to make my floor look better. How's that going to be treated for tax purposes? You want to hit on repairs versus capitalized expenditures that go on a house?
Sure. And this really affects not just personal people in their houses, but business owners too, right?
For sure, yeah.
I'm doing a rebuild on my business, and I want to know, can I just write that all off as a repair, right? Well, it really depends on what you replaced, right? Because everything's got its own, we call it life.
Absolutely.
Right.
Yep.
So, what was the life of what was replaced? If I replaced my AC unit, right, versus replacing my roof, right? That AC unit only probably has a 5 to 10 year life, depending on what you got. Okay. And keep in mind, what the IRS says is the life of your unit is not the same as what your retailer is telling you is the life of your unit.
That's right.
Your retailer can come in and go, this is a 20-year AC unit. And the IRS can say, that's a 5-year asset. Okay.
Yep.
So it really depends. But you have to look at the life, and you also have to look at, did I increase the value of my property?
That's key, right? So if you're doing, let's just say, a repair on your roof and you're replacing a few shingles, obviously that's repair. But now let's just say you've taken those shingles and you put a metal roof on there.
Yeah.
Or you put clay tiles up there.
Yeah.
Okay. Now that's an expenditure that needs to be depreciated out over the life, whether it's a 39-year life or 27 and a half residential or commercial.
Right. Yeah. And so it really there's a whole lot of things that we have to look at as far as, can I just take 100% write-off on this thing and call it a repair? Or am I going to have to capitalize it and depreciate it over time? And this is one of those things that there is no bonus depreciation.
There's none. There is absolutely none. But I do want to kind of take this topic a little bit, Rick, if you're okay with it. And one of the areas that I'm seeing is very popular, it's been very popular for the last 5 or 10 years, is people who decide to invest in these commercial developments that we see. And these organizations will do what we call a cost segregation study.
Oh, yes.
And look, first and foremost, let me tell you something, guys. Cost segregation study is very expensive.
Yeah.
Okay. Basically what it means is, think about the terminology. It is the cost that is basically segregated, okay, out versus, okay, if we decide, okay, we're going to be doing leasehold improvements and that's 15 years. Whereas now we can take specific, the lights, the paint, things like that. We can break that down very granular in a sense and expense certain things that accelerate the depreciation under this cost segregation study. So it's given people that put their investment in here a very large deduction in the first year as they accelerate expenses. I would say this, and this is what people need to be careful on. Same thing for buying vehicles and whatnot, is while it might be a great tax vehicle per se for the first year or so, is it still a good investment?
It can be.
It can be, but not always.
But not always.
Yeah. So that's what you have to be careful.
Yeah. And we see this all the time of people that invest in these projects just to get a tax deduction.
Yes.
Right. And this goes back to do you buy a vehicle just to get the tax deduction?
Not me.
That doesn't make sense.
No, it doesn't. So I guess what I want everyone to understand is be leery, right? Because they tell them like, hey, well, same thing goes for these oil and gas wells, right? These intangible drilling costs and oil and gas depletion. We can get you up to 85% of your investment deducted in the first year. But a lot of times what that does too is erode your basis in there too.
Right.
Okay. And then if you start to sustain additional losses, but you have no basis, guys, there is what they call suspended losses unless you pump in additional capital that's associated with it. So you got to be very careful. Okay. You got to be very, very careful when they try to say, oh, we're going to save you all these in taxes. But would you really spend $100,000 to get an 85% deduction when you're only in a 25% tax bracket? So then you're only getting 25 cents on the 85%, roughly 20%. So you spend $100,000 to get you $20,000 in savings.
That's right.
That's all it is, guys. So you got to look at all sides of this quadrant and make sure that it's a good investment and you're actually going to make money on it.
Well, you mentioned the word basis. And so let's talk about what that really means, because that's, I would say, the number one for our business owners. They don't understand this term of basis and why it affects their tax so much, because so many times a gain, a loss, a net income, a net loss affects your basis so much. And then you don't understand, well, why am I having to pay taxes on this? Or why aren't I able to take that loss?
Great example. Let's just say, for instance, Rick and I go to start a business together, right? And we're going to be 50-50 partners. And let's say I'm the investor in the sense, right? Rick's going to own 50%, but it's going to be due to sweat equity.
Yeah.
Okay. So I'm going to put $100,000 in this business. And let's just say in year one, we lose $50,000 in the business, right? I'm going to get a $25,000, 50% of that K1 is going to roll back as a deduction. Guess what Rick's going to get?
I got nothing.
Zero. Because he has no basis. Sweat equity does not nominate someone for a basis. They actually have to put skin in the game or capital into this business, okay? I would still get, I put $100,000 unless it wasn't a loan, right? If it was a capital injection, I'm going to get I'll have 100,000 basis in there. However, I'm only going to get 50% of the 50,000. And so you got to be careful, guys. When someone says they're going to get you this loss, that loss, and everything else, once you erode your basis, the only way you get more basis is either all of a sudden you have earnings, you take on some debt, or you put some capital in there.
That's right.
If you can't do one of those three things, you're not going to get the deduction.
That's right. And so any of those losses then become what is known as a suspended loss. You don't lose it forever, but you don't get to use it unless you have basis in the future to offset it with, or future income that you could offset it with.
That's correct.
Right?
That's correct.
And so, especially a lot of these businesses that take 3-4 years to really get off the ground, you're going to have loss after loss after loss. And people are going, why aren't I seeing a benefit from this? You have no basis.
That's right. And here's the other thing you got to be careful on. Let's just say Rick and I have that same situation, right? 100,000 I pumped into it, 50,000 loss. But let's say Rick says, Jake, I need some money to live off of. So I need to take a $25,000 distribution. Well, we know these are pass-through entities, but here's the problem. Because Rick doesn't have a basis, that $25,000 in distribution is going to be taxed as cap gain distribution tax on Sched D. So now he's going to have to pay 20% on that $25,000 because he has no basis.
Yeah.
So anytime you take a distribution that is in excess of whatever your basis is, when it goes to zero, you have cap gain distribution tax. And a lot of, there's a lot of clients, they fight with us on this all the time.
Yeah.
They'll say, well, I just took a distribution and I thought this was a pass-through. And yeah, it is. But unless you have a basis in there, it's going to create a taxable event.
Yeah, we see this especially with loans, right? So I'm going to go get a small business loan, a couple $100,000, and I'm going to use it to live on while I'm waiting on my business to take off, right?
Can't do that, guys.
And so I take these distributions and I'm like, well, but it's a loan. Well, yes, it is a loan, but that money was meant for the business, not for you.
That's right.
If you take that money out as a distribution and you have no basis in your business, that money just became taxable to you.
That's right. That's right.
And so that's really hard for taxpayers to understand, because they're like, but that's not income. I didn't earn that in the business. Correct. But you did take it out of the business as a distribution.
And how the IRS views it is you gained a benefit off of that.
Correct.
You gained a benefit. So that in itself, because you eroded your basis, created a taxable event.
Yep.
Yeah. Yeah, great, man. This is great. As we talk about, and we've talked about it already, documentation. How to document expenses during business travel, though. Rick, it's very important, man. I see people that come to me all the time and say, hey, I want to go on a vacation. I want to write off the vacation. You can't do that. You can't just write off your vacation like that.
Or can you?
Your vacation has to be around, right? A business purpose.
That's right. And so these seminars that we talk about, the cruises and things like that, the primary purpose of taking that vacation cannot be the vacation. It has to be around a business purpose. So the person that says, I'm going to take this 4-day cruise out of Galveston,
yes,
and it's a CPE conference. Well, as long as more than 50% of that conference occurs over the 4 days,
yep,
you may legitimately be able to write off that cruise. But if the conference is only 1 day and the rest of it is a vacation, guess what? You can't take that as a deduction for your vacation. I hear the same thing about, I'm going to go visit a client that lives in Hawaii, right? I'm going to spend a week down there and I'm going to visit a client. How much time are you spending visiting that client for that week?
If you're in our profession, you better be able to charge your client for some tax planning you've done down there and spent a substantial amount of time.
Yeah.
Years ago, I'd fly out to New Mexico, or I'd fly to Durango, where me and my business partner at the time had a condo. And honestly, it was go, go, go. It was 6 meetings a day, Rick. I would go from one person's house to the next person's house. So 100% of it was deductible, because that was my sole intention. Look, nothing against New Mexico. There's some beautiful areas. I wasn't going to Farmington to to do anything other than meet with clients. That was my intended purpose. But I had documentation every place that I went, right?
Yeah.
Every client could vouch for every place that I went, and all the subject matters. And I'd always send recaps on everything that we spoke about.
That's right. Yeah. And again, I know we harp a lot on documentation, but it is the key thing for everything that you're going to be doing. Document, because if you can substantiate the business legitimacy of anything that you do, anytime the IRS calls it into question, having that documentation is what's going to protect your butt.
Yeah, absolutely. When we're talking about receipts, you must retain a receipt or some type of similar documentary evidence for every lodging expense that's over $75. And realize that receipt must illustrate the amount, the date, the place, and the essential character of it. Okay, guys, if you're not doing that, you're going to get hung. Okay, on a lot of audits and things that I've represented, I know the IRS states certain things, and they always want itemized receipts and all that. I can tell you from experience, Rick, that sometimes bank statements, credit card statements, if they can reasonably determine, an auditor, if they can reasonably determine what that expense was for, right? If it says Papacitos, okay, they know that was a meal, is what that was. Where you run into problems on, if you go to these multifunctional stores, like even Office Depot, right? Or Office Max or Walmart, Target, well, you can buy just about anything there. If you don't have itemized receipts for those, it can be very difficult. You give it up. If you don't have itemized receipts, you give the discretion up to the auditor, is what you do oftentimes. And so I always say, be careful if you let's just say you run to Best Buy and you buy $1,000 item and don't have, it could be a television for your home and you're trying to run it as a business expense. So you better make sure you have itemized receipts for what you're buying. if it's smaller items, I've seen the IRS make, reasonable. Okay, that makes sense that they did this. But when they start to question things is when they start to see you took a lot of frivolous expenses, then they'll start to question everything at that point.
Yeah. Great. The Walmart example is the one I always use with clients is you can buy groceries there. You can buy things for your car there. You can buy clothes there.
Yeah.
You can buy appliances there. I mean, so people think I've got my bank statement. It clearly shows I spent $200 at Walmart. Why are they questioning this? Well, what did you buy? That's what that receipt's for. It shows what you bought. And, the great thing, you mentioned Best Buy, right? Let's say they bought that $1,000 TV. Well, maybe they bought it for their business.
Yeah.
Right? Is that TV hanging up in your business?
It better be. We just did the other day.
Yeah.
Right. And so we put up all of our client financials on there because it's tied back into our server.
Yeah.
And that was a driving force for it because in our conference room, it was very difficult for clients to see on these smaller TVs that we once had. Right. And so we wanted to make it where our clients could, be in a very comfortable setting and be able to read all their financials. We could go over it with them.
That's right.
So you got to make sure that you're doing what you say you're doing and how you're reporting it.
That's right.
If you own your own business and you operate as a proprietorship, which you know what, Rick, that is in today's society, that really irks me. If you're a legitimate business, honestly, and you're operating as a sole proprietor, why is anyone doing that nowadays? I don't even really understand why anyone would want to do that with how litigious society is nowadays. At least create an LLC.
Yeah.
Would you agree with that?
Yeah. The most audited piece of paper that ever existed is Schedule C on the Form 1040.
Absolutely.
And that is because it is so abused.
Absolutely. Guys, even if you are a single member, right? You set it up. If you don't want to pay somebody to file a partnership return or an S corp return, you report as a disregard entity. If you're doing work for somebody and someone says, "Hey, I need to 1099 you," the way identity theft is, I would rather hand them an EIN for my LLC, wouldn't you?
Yeah.
Than my social just kind of thrown out there.
Yeah.
You got to be careful with that kind of stuff. So if you're, it gets back to what we talked about. If you are serious about business, you need to do things right from the onset. Okay. But let's just say, so if you own your own business and you operate as a sole proprietor or a partnership wherein your spouse is not a partner, they say one of the smartest tax moves you can make is hiring your spouse. And you've probably seen this too, is hiring your kids as an employee.
Yep.
Okay. Why is that?
Well, so there are some tax benefits to hiring family members, right? Now, I will say the biggest one is the kids.
The kids,
right?
Absolutely.
Because there are ways to pay your kids and not pay any payroll taxes. That's your Medicare, Social Security, FICA, FUTA, you name it. It's not on there. And that can add up to nearly 10% of the taxes on that payroll. And you can pay them up to the current standard deduction, which this last year was $12,950.
Yeah.
So that's nearly $13,000 per child that you can pay your kid. Now, there are some caveats to that, right?
You're going to have to file a tax return for that.
You have to run payroll.
You have to run the payroll.
You have to run payroll, and you have to file the payroll reports.
Yep.
Your kid's still going to get a W-2.
That's right.
Right? Now, they're not going to pay taxes. It's going to be a zero return.
Correct.
Because the standard deduction will wipe it out. But on top of that, the kids actually have to do something to earn that money.
They have to. They have to engage in the business. They have to have, once again, an intended purpose comes out again.
Yeah.
Right? So I don't care if your kid goes up and decides to take out the trash and sweep around there and you pay them a arm's length agreement or a market rate, but you need to make sure that you have, and typically an employment contract actually helps as well.
Yeah. Now, as it relates to hiring your spouse, the wages aren't tax-free.
No.
But maybe there's some fringe benefits that we can pay our spouse and get a deduction for and be able to benefit that way, right?
Yeah, yeah.
Maybe it's some health reimbursements, right?
Absolutely, yes.
Maybe it's some child care reimbursements.
Dependent care expenses.
Yeah.
Yeah.
There are some legitimate deductions you may be able to run through your business as fringe benefits that will help pull money out of your business tax free.
Yep, that's right. That's right. So, like I say, once again, Rick, this gets us back to you need if these are topics, that keep coming up. If your current CPA or EA is not having these conversations with you, you need to find someone that will.
Yeah.
You need to have the right people on your side, because you could be leaving money on the table.
Yeah, that's ultimately what this is about. Is from an advisory standpoint, showing people that there may be a few $100s here, a few $1,000s here that you can pull out of that business legitimately for tax purposes that will save you money at the end of the year.
That's right. That's right. And it gets back to just making sure everything's done appropriately, and consulting. Advising is key. Okay. But I want everyone to realize that, most people don't understand this. They think that they hire you to do their taxes, right? That's compliance work, right? So there's an educational piece where it's advising, and that educational piece, it does come at a cost, right? But what I would say is when you're going through your introductory meeting with your accountant, right, and they're doing like an onboarding per se, a lot of good information should be shared. And then a plan should be given back to you as what the CPA or the EA's recommendations are and what you need to be advised on.
Sure.
Okay. And if you have a good CPA, a good EA that does good consulting, good advising, I will tell you that it's the value you will gain from that is well worth the small amount of money that you'll spend on that.
Yeah. And that's your advisor should always be able to show you that the money that you spend with them is returned back to you in tax savings. And usually it should be a multiple of that.
Absolutely.
Yeah. That's one of the things that Jake and I, we harp on in our practice is, for the dollars that you spend with us, this is what we're saving you. Legitimate savings year over year.
We've seen situations where when someone comes on board, they've been advised incorrectly, right? And they have $100,000 tax liability off that. We do a restructuring with them. Yeah, it might cost them a few $1,000s on some advising and the new entity formations and whatnot. But now they've reduced their tax liability by like $80,000.
Yeah.
Okay. Now that doesn't work for everybody, but that's just an example, and that has come up. That's probably an excessive one. That much savings that we've seen only a couple times, but restructurings that we've done has cost several thousands of dollars. I know that I've seen $10,000, $15,000, $20,000 that it saves in year one. That's not unheard of.
Well, yeah.
And then you're going to have that every single year, so that the amount continues to grow. So once again, just harping on, you got to have the right team in place.
Yeah, I recently had a sit down with a lady that's buying her parents' business out. They're ready to retire, right? And all that income that they've been enjoying now is going to flow directly to her.
Yeah.
Right. Well, it's a sizable amount of money. I mean, I sat down with her, and within an hour, I showed her $120,000 in taxes that I was going to be able to save her by setting up a different structure for that business. Now, again, like you said, this isn't it fits for everybody. It does, it works this way every time. But she was using the family accountant that they'd had for 20 years and had never even met with that accountant. Ever in 20 years, had never met with that accountant. Had just sent the stuff over, had the taxes done, signed off of it, and gotten filed.
Yeah, and I know everyone wants to blame the accountant. And sometimes the accountant might be a little bit at fault, but what I would say is this is your life. These are your taxes you're paying. Take the initiative. Either sit down with your current accountant or find you one that you feel comfortable with and go through it. I promise you, if you have the right team in place, it's going to be worth its weight in gold.
Absolutely.
It's going to be worth its weight in gold. A couple more things I want to kind of hit on, if you will, and then we'll kind of wrap this up, Rick. One of the things is if you're an owner of a corporation and you decide you want to, book a home office deduction out of that, it gets back once we talk about documentation, and you need to make sure that it is a real office.
Yeah. So one of the things that we talk about, if you've got an S Corp or a C Corp and you're wanting to write off what we call reimbursements, right? For either a vehicle, a home office, even personal expenditures that are for the company, right? Your company needs to have a formalized reimbursement plan.
That's right.
That's, again, documentation. If you do not have that, that is one of the first things that the IRS agent's going to ask for is, let me see your paperwork on your reimbursement plan.
Yep.
Right. You need to have a reimbursement plan. There's several out there that you can put into place. They can be dollar for dollar. They can be a percentage. They can be a number of different ways. But you need a formal reimbursement plan, and that reimbursement plan has to be followed to the letter, right?
Yeah.
Whether it's submitting reimbursements monthly, quarterly, annually, and how those are going to be calculated, it needs to be documented. Okay. So if I want to take a home office deduction and I have a reimbursement plan in place with my corporation, then what am I allowed to do? Well, it's no different than what you do as a sole proprietor. You're not allowed to take your whole house and deduct it, right? It's a proportionate share of the expenditures, utilities, maintenance, that sort of thing. And then the second piece of this is cutting a check.
That's right. That's right.
Cutting the actual check for the reimbursement. We see this all the time. I'm going to run this home office deduction through, but I'm going to treat it as contributed capital. I'm going to increase my ownership and take a deduction. That's not the way it works. It's a reimbursement for your personal expenditures out of the business. You have to write a check to yourself.
And guys, that check that you're writing, that Rick is alluding to, that is a form of documentation. Once again, the same terminology we keep using over and over again. One of the things I would add to that as well is you need to make sure that it's a defined office. It truly is a defined office, and you're using it regularly for corporate business. Okay, you can't be staying in an apartment and just use your whole living room and say this living room right here is going to be my home office
or my garage.
It has to be something that you're using all the time on a regular basis, and it is exclusive for that purpose. Exclusivity matters. And once again, your intended purpose matters. Okay, guys. So documentation, intended purpose, all this matters. Okay. It matters more than what you think. The kiddie tax, Rick, I don't know if that's something you want to talk. I know we kind of hit on it just for a little bit, paying yourself out of there.
So the kiddie tax is more about children that have their own sources of income, and usually those are passive sources of income. I set up a brokerage account for my kid and put $10,000 in there, and they're getting dividends out of that portfolio, right?
Yep.
Do I have to pay taxes? Does my kid have to pay taxes on that portfolio, right? Well, it depends. It really does on how much are you earning out of that portfolio, because there's both passive and active income tests for the kiddie tax. And if you don't know what the kiddie tax is, it is a long time ago, and I say that, back when the dinosaurs roamed, people, what they did is they shoved their income down to their kids.
That's right, because it would be taxed at a lower marginal tax
so that
bracket.
It could be taxed at a lower rate, right? And the IRS, being the IRS, goes, we know what you're doing.
Of course.
And we're going to put this law in place that says if your kid is earning X number of dollars passively or actively, we're going to charge the parents' effective tax rate on that money.
I remember that. Yep.
Okay. And that law's still in place, right? So what this is basically alluding to is parents that are trying to shove some of their own income down to their kids so that their kids can pay a cheaper tax bracket. Now, for most people, this isn't really going to apply. Even setting up a small brokerage account, you're probably not going to earn enough in dividend income, interest income, that sort of thing, right? But the thresholds, okay, are $2,500, okay? Now, that sounds kind of pennies on the dollars, right? But over the course of a year, if you deposit 10 grand this year and 10 grand the next year, and you're being a good parent and fiduciarily taking care of your kids and trying to set them up for life. And eventually 5-6 years from now, that account has grown and now it's a couple $100,000 and it's earning dividends. You're going to be subject to the kiddie tax rule.
That's correct. So, IRS is, as well as very astute to this stuff going on, And so I would just always say, be very careful. Rick, I think this has been great, man, today. I want to thank you for coming on board, and hopefully we can continue to do a lot of these together.
Yeah.
I know there's going to be various different topics we're going to talk about. Ladies and gentlemen, we're going to bring on some of our clients, some very successful business owners in the area on the podcast. We're going to talk about how they got from point A to point B to point C to point D, right, as they continue to progress. It's going to continue to talk about having the right people in your corner, right? The right people to help guide you and get you to the next level. We just love to share information with you guys. If you have any questions at all, feel free to reach out to us. Like I say, these podcasts are nothing more than informative information, and hopefully you guys get excited as much as Rick and I are excited to share this information. We thank you for your time today, and God bless.
Yeah, thanks.